First up, taking money offshore to invest in global equity markets can present investors with literally thousands of choices and at least a few pitfalls. Sanlam Private Investments recently identified 3 of the most common pitfalls investors are prone to. These include over-diversification, selling too early, and owning value traps. Here to discuss these in more detail from our Cape Town studio, Peter Fourie, Head of Global Equities at Sanlam Private Investments. Peter, thanks so much. Let's kick off with, if you were to choose between those 3 big mistakes that investors make, which is the biggest?
I think owning value traps is probably one of the more common mistakes. So what we try and do in our process is to identify industries and businesses which are challenged and try and focus instead on businesses that have durable business industries that they focus on and durable business models as such. I think lately the best example of a business that's properly challenged in terms of competitive forces in the marketplace is companies like Dell and Hewlett-Packard. You probably find that their revenues are now declining, their cost base don't reflect the reality from a few years ago, and they almost have to reinvent themselves at the moment.
Peter, just on that note with the value trap that we talk about, it seems to be very evident, and when we're talking global equities, it seems to be very prevalent in the technology space. I just think back 12 years, shortly after we had cellular phones introduced in South Africa, how dominant Nokia was. And then another 6 years later, RIM with the BlackBerry. Is it something that's especially sort of endemic to the technology companies? And why do we find these value traps there at the moment?
It is, of course, an industry which is quite dynamic in terms of its change from year on year and decade on decade. There are, however, some subsectors within that industry, including software companies, where you find that these businesses tend to be a bit more durable in terms of their business model. A good example would be SAP in Germany, the world's leading application software company. It's a business that's well diversified. It has much more of an annuity type income, and it has been able to move with the times. For instance, at the moment you have, of course, cloud computing that's very, very topical, and they've managed to evolve their business to cater for that new demand within businesses. You compare that to a business like Oracle, which historically is focused very, very much on databases. Now they're trying to move into the cloud computing industry much more aggressively as well. So we could end up owning both a business that's at the forefront of cloud computing like SAP. You do, however, pay higher multiples than for a business like Oracle. But we feel that both the management teams ultimately will succeed in their goal of growing their business, first the top line and then the bottom line as well,
Peter,
by making sure that they stay on top of their league. However, when you look at hardware companies like Cisco, for instance, the jury's still out whether those gross margins that they historically has enjoyed, as well as their net margins, won't be eroded away, because of course they're customized.
Peter, I need to interject. Peter, I need to interject. If we can just move on,
sure.
Still with the value trap theme, we refer to Motorola, we refer to RIM and Kodak as value traps in the global arena. Can you give me some color on what you deem to be value traps or well-known value traps in the South African space?
Quite a good question. I guess in this industry, perhaps some of the mining stocks, the gold mining stocks might be an example like that, where if you look at the theme of the gold price, I think the Rand gold price have compounded at about 12% per annum the last 10 years. Yet these businesses have not been able to put that to good use in their business model, because costs have indeed gone up much higher than their revenues. So that would probably be a good example of a value trap.
Peter, I'm just always fascinated to understand why investors make these mistakes. Do you think it's a case of putting too much emphasis on past results and not enough emphasis on where the company is going and their particular role in the dynamic situation within an industry?
Yes, I think as global fund manager, you are of course driven by fundamentals in terms of your screening process. So when something looks optically cheap, you are tempted to go and investigate that business. However, we feel that when you look at a business, for instance, like Colgate, which almost never trades optically cheap, it is worth paying up for businesses where they compound their growth meticulously and without a doubt every year. And often it's best not to just go and buy a stock that looks cheap for the sake of it. One other example would be a business like the brewer industry, which looks very different to 10 years ago, where you have quite a few big players now dominating that market space, and where we think margins will probably continue to go higher, and it's worth paying up even though it looks a bit more expensive than it used to from a couple of years ago.
Let's focus now on selling too early. Sometimes it's difficult to hang on for a long period of time when you've got a great return. Do investors err on the selling of stocks too early more often than not, in your opinion?
Yes, I think so. A good example probably would be the tobacco industry. I mean, Philip Morris, which has been a core position for us for a while, have suffered from declining stick sales or cigarette sales for the last 20 years in industry in regions like the US and Australia. Yet when you look at the business, it has bought back stock aggressively. It's also declared very good dividends, and it's managed to grow its margins notwithstanding a declining volume outlook. So I think it's very, very easy to sell too early just because some news flow looks poor in the short term. Yet it's very important to understand the dynamics behind the business and to make sure that that's still a good business. And often, you know, you are rewarded for the risks that are well known in the marketplace, but where most investors fear to tread.
Peter, I have to weigh in here and ask you. We've been having this debate for some time on this show and off it with fund managers throughout the country. Many of the fund managers have missed the boat on the retail shares, which appear to be companies that have been growing their intrinsic value very quickly over a number of years. Do you think that's one of the areas where perhaps even professional investors have erred on the local market with the retailers, or do you think they're fundamentally overvalued?
Yes, we do discuss this amongst ourselves quite often. I think that the overseas investors, the large institutional investors, have really piled into this area of the market, and they've done probably in some cases much better than the local investors. I think as local investors, speaking on behalf of local investors from a London perspective, I think they are, of course, like ourselves, quite valuation driven. And even though we don't deny some of the great business models behind a Mr. Price and a ShopRite, etc., we just think that the valuations probably reflect quite a bit of good news at the moment. So I think it's because of the local fund managers, their focus on historic margins, which of course versus the reality today is very, very high. And the fact that valuations reflect a high rating on high earnings per share probably meant that most local fund managers did miss that boat.
Let's talk now about the third mistake that investors make in your book, and that is over-diversification, perhaps being a little too cautious and not having a high level of conviction when it comes to any stock, any geography, or any particular sector. Just let's get your thoughts on that front.
Yes, I think that during the way we construct global equity portfolios, we like to stay away from areas of the market that historically just did not produce the goods in the very long term. An example would be utilities, for instance, where your returns often get regulated away by governments. So we feel that even though you might have a fairly focused list of 25 to 30 names that you believe have secular growth trends behind them and where the business models are durable, as I've said before, we feel that almost taking leave from Warren Buffett, that if you know 25 to 30 businesses very, very well, it's much, much better than owning 50 businesses where you only know 25 very well and 25 not that well. So I think if you have a great business that you've identified, it's very much worth it putting a lot of capital behind it relative to your overall size of the portfolio, and that has historically worked very well for us. So I think 25 to 30 stocks in a global portfolio might be very aggressive for most investors, but we think there are some great businesses in the world, and they are quite limited. So if you do find them, you do need to put some capital to work in decent sizes.
Peter, at last count, I think I recall seeing that there was about 10,000 stocks listed on global equity markets outside of South Africa. You know, where do you advise clients to start? Where are you seeing value at this point, and how would you go about looking for shares amongst this ocean of equities out there to put those to find those 25 shares to put in your portfolio?
Sure. I think we have, of course, our own screening process, and typically we identify 80 to 100 names that we look very, very carefully at any particular point in time. At this stage of the cycle, after the S&P hit its old highs 12 years ago, we still find the large cap quality names screen quite well for us on a relative basis. That does mean that you tend to go to the Bloomberg Top 500 list, or alternatively the S&P 500. It's also true that after many, many years of secular decline, Japanese stocks per se screens quite well in terms of valuations, but we are worried about their business models. So therefore our continued focus would be on high quality large cap names, which we feel after a period of very long underperformance in a very long historic context still have more room for outperformance going forward.